But what about the state of the economy? Who better than Rashesh Shah, Chairman and CEO at Edelweiss Group, joining in to highlight exactly that. Rashesh, hi, good morning. Good to have you on the show with us after a long haul, I admit. But how is it that you're assessing the recent government announcements on the NBFC sector? Would you say that these are enough to revive the sector, so to speak? Because that is what really needs immediate attention, and that's where this entire, slowdown fear sprung about from.
True. I mean, as all of you have been observing, the economy has been slowing down for the last few months. But the good news is, I think the government has at least intervened. They've been listening to all the stakeholders. They have very promptly taken a set of actions along with RBI, and the coordinated effort between the government and RBI is also very good for the economy as a whole. So I think things were getting worse, but I think that the last couple of weeks, slowly and steadily, a little bit of green shoots about confidence that India will not slip into a very big slowdown, because last 2-3 months what we saw in auto and a lot of other sectors, there was a fear that this might become a structural slowdown. I think increasingly more and more people are believing that because of the government intervention, RBI cutting interest rates, liquidity also becoming easier, in the next couple of months we'll start seeing the uptick again. It won't be a what we call a V-shaped recovery, but at least things have come back under control. Confidence and sentiment have clearly improved in the last couple of weeks, and hopefully this will be a precursor to the economy coming back, because there is a cyclical element, and we've been slowing down for almost a year now. And what we have seen is usually an economy like India, because no matter what we do, given the demographics and the urbanization that is going on, the investments in infrastructure that we need, our economy cannot grow very slowly. So between 6 to 7 should be the normal growth. And if we come back to that, things will be okay. Obviously, to really fulfill our aspiration, we need to go beyond 8%, which will take some reforms and some global cues and all of that. But I think the slowdown should get arrested pretty soon, is what the optimism now coming back.
Rashesh, morning. Let's also talk about the monetary policy transmission. Do you think that that's really happening on ground? Because that's been a big complaint when it comes to the sector. Are banks actually ready to pass on the rate cut benefits on ground? Not just talking select, but the entire banking sphere.
They are, historically we have seen that when interest rates come down very sharply, and we have had very sharp fall in the last 6 months from RBI, almost 110 basis point cut from between February to now, which has been fairly sharp in India. Usually banks pass on about 30 to 40% of that transmission down to the ultimate borrowers. What we are seeing right now is even lower than that, but I think the banks has started to pass on. RBI is trying to nudge the banks. Government has also been nudging the banks. So the transmission has started happening. We have started seeing it in August, and experience has also showed that it takes about 5 to 6 months for RBI rate cut, when they start cutting the rates, for really confidence that rates will stay lower, and then banks pass on. What happens with banks is they wait to be sure that the interest rate falling down, the direction is now more or less steady, and when it is steady they start passing it on. So I think we have seen about 5-6 months of continuous rate cuts. This should now start giving confidence to the banks that they can start transmitting it more and more. Plus, credit demand has slowed down. Banks are very keen to increase auto loans and home loans. August, we have seen a lot of the PSU banks have become very active in the home loan and the auto loan market.
So would you say that, the margin trajectory would be anywhere better, Rashesh, for FY20? And also, the funding cost environment, would you say that it's begun to ease? Because, as we've also all been chatting about, the problem is not really with a crisis of liquidity. It's a crisis of confidence in lending to corporates right now. Do you think the mood or sentiment is changing at all when it comes to that?
It is starting to change, as you very correctly said. It's a crisis of but more than crisis of confidence, I think there is a general risk aversion that is set in. 4-5 years we have had a lot of NPAs in banking sector. Corporates also have not seen profit growth for the last 5-6 years. So the debt to equity for a lot of companies has gone up. So corporates also have become risk averse. They want to shed assets. They want to deleverage themselves. So, and the banks also on the other side are not as as open as they were in the past to start giving big wholesale loans to corporates and all. So I think there was a general risk aversion that is set in, but we have seen that over the last 2-3 years, and it got aggravated in the last 1 year post October last year. Hopefully, with interest rates coming down, with banks also now being more comfortable on asset quality, we should start that coming back. But I don't think the corporate borrowing should really pick up for at least another 5-6 months. So I would say that would be after March 2020, because I think corporates will also have to start taking risk, and what we call the animal spirits will have to come back. The banks will also have to start funding projects and taking some amount of execution risk. I think we are maybe a few quarters away from there. But on the retail side, I think banks are stepping up. As I said, auto loans and home loans and all have started. A lot of the PSU banks have made inroads into that. So whatever slack, NBFC credit disbursements have slowed down. So we saw a slack in between, but now the banks should start picking up some of that slack, and that will also be good for the economy, because last 4-5 years when banks have slowed down credit growth, NBFCs had picked it up. Now last 1 year, because of liquidity crunch, NBFCs have been slowing down their credit growth, and banks have taken a little bit of time to pick it up. But I think that will be good in the short term. And as I said, in the medium term, the private capex has to come back, and for that both the corporates and the banks will have to shed some amount of risk aversion.
Now, the RBI, Rashesh, has transferred nearly 1.76 lakh crores of dividend to the government. We saw that announcement coming in. It's going to be a huge booster, but what do you see the overall possible utilization of these funds?
So I think it's a good thing. I think RBI has had some excess reserves which with the Bimal Jalan committee has quantified, and this coordinated action between RBI and government to boost the economy, to do whatever it takes to get the economy back on track is very welcome. And I think all investors, local and global, have been very gratified to see this coordinated action. I think out of the 1,76,000, we should keep it in perspective that about half of it, close to 90,000, was anyway what the government was expecting and had already budgeted. So that I would keep it aside, because that has already been provided for, and government has already planned how to use it when they announce the annual budget. So I think there is about 86,000, 85,000 crores extra that the government has got, which I think will be used for 2-3 things. I think first to recapitalize the banks, in a sense to front load the recapitalization of banks, because I think that was required to fund some of the infra projects, as well as fund NHB and NHAI and all, because the government funding to NHB, NHAI will also allow them to, they have announced 20,000 crore that NHB will give to housing finance companies. NHAI has got spending to do. They have to disburse money to a lot of the road developers and all. So I think if this goes via NHAI, NHB, via the bank capitalization, it will have a multiplier effect, because the banks will also start then stepping up on credit, because quite a few banks are in PCA. So the moment they get the capital, they may be able to start on the disbursement and credit growth again. So I think these are the 3-4 channels, because government itself has been spending money, and there are a lot of government programs are there. This extra 85,000 they have got may not be immediately be usable for government programs, because government programs take a little bit of time to conceptualize and all. But via these agencies who are funding large part of corporate India, it will help a lot to spur the economy into action.
And one of the most beleaguered sectors, Rashesh, which you also track pretty closely, real estate, that's been facing stress for quite some time now. What possibly do you think can be really done to revive the sector?
I think if you look at real estate sector, there are that there are two issues which are there, but there is some good news also on the anvil. So I think on the two issues which are there, the first one is obviously the demand supply imbalance that has been there, because a lot of projects which were launched maybe 8-9 years ago, a lot of that inventory has got bundled up. So there is a demand supply gap that has been there for the last few years, which has been overall good news because prices have not gone up. So if you look at average home price in India for the last 8 years has been more or less flat, in which case on a real basis, if you do it on an inflation adjusted basis, real estate prices have actually corrected on inflation adjusted basis, which is good news because affordability has improved on that. But there is a demand supply imbalance for sure. The second problem in the last year, a lot of real estate companies are facing, a lot of the projects are facing, is a liquidity crunch to complete the project. So as the project completion cash flows are getting stretched, the projects are also not getting completed as quickly as possible, which is obviously has its own issues around cost of the project going up and their ability to deliver homes to the buyers and all that. In a way, this slowdown is also reducing the inventory available. So I think, as I said, there is a little bit of good news that the prices can get stabilized because the inventory is not coming to the market as quickly because of the liquidity crunch. And the other good news I'm hoping for is the government has been working on a package for home buyers and realty sector. The Maharashtra government recently announced a reduction in premium for a lot of projects in Mumbai, which will bring prices down between 5 to 10% in Mumbai, which is very good news. And coming up with the Maharashtra election, this will be very good for the Maharashtra economy as a whole. So I think some amount of government action, some amount of demand supply balance being restored, and some amount of liquidity available, especially for last mile completion of existing projects, will solve this problem. But I think it will take another couple of quarters. So again, I feel fairly good about this. If we solve this, then by March 2020, we might start seeing uptick in real estate. Commercial real estate is already doing well. Housing real estate needs to come back.
Rashesh, just a quick word on the company. What is your total exposure to stressed accounts, and are you adequately capitalized for growth? Any fundraising plans as well? I've sort of just squeezed in a few questions because we're running a bit short on time.
Yeah, actually we just announced our results a few quarters ago, and we had a whole conference call with analysts and investors, and in the transcript we have spoken about our credit book, asset quality, all of that. Our gross NPAs are slightly above 2%, 2.3 or so. So we have tried to keep asset quality under check. Of course, as I said, there is a liquidity crunch in the economy. A lot of the borrowers are facing cash flow stress, but idea is to be able to manage it and monitor it. Fortunately for us, half our book is retail on the credit side and half is wholesale. On the retail, things are going well. Home buyers and SMEs and all are doing well. They've gone through stress a couple of years ago when demonetization and GST happened, but I think the retail book is doing fairly well. Wholesale also, I think overall, if you are proactive and you can monitor the projects and you are in touch with your borrowers, you should be able to manage the asset quality, is what our hypothesis is. We raised capital in our NBFC. In fact, very few NBFCs have been able to raise capital. We have raised equity capital of 1800 crores from CDPQ for our credit NBFC business, out of which 1040 has already come in, and so that business has got fairly well capitalized, and as we get the future tranches, that capital will allow us to continue to grow on that. We also recently, a few weeks ago, announced capital raise in our advisory business. We have an advisory business also, which is asset management, wealth management, asset reconstruction company. So we just announced a capital equity raise in that also. So I think with both this capital raise, our gearing has come down. We used to be at peak gearing of 5.2. We have now come down to about 3.7. So with this kind of gearing, I think we are adequately poised to manage, the current environment, but also have a lot of headroom to grow. And I feel growth will start coming back post March 2020. So I think in that sense, FY20 for most of the India Inc. as a whole, for NBFCs and all, may not be a big growth year or a big profit year. But if you strengthen yourself between now to March 2020, there should be a lot of growth available after March 2020 for all sectors as we come out of this recent slowdown as an economy.
Good to get in your thoughts as always, Rashesh, and we should plan a detailed discussion on Edelweiss as well sometime later. Loads to talk about on the points that you just mentioned, but
Thank you.
good speaking with you.